And now we've slipped below 23,000 as well. 22,929 to be precise is where we're at. The India VIX has spiked up 8.5%. Nifty Bank is also under pressure, 2.25% cut coming in on the Nifty Bank. Sectorally, you do have some speck of green on the market today. It's the Nifty IT index, the only index in the green right now. Otherwise, you have some massive cuts coming in on PSU banks, lower by 3.25%. Auto, realty, banks, finance, defense, FMCG. Speaking of FMCG, 1.25% cut on that index right now as we speak. But other than that, the FMCG space has been in focus given this entire LPG issue that we've been seeing on the back of the tensions transpiring in the Middle East. And other than that, also paints. The kind of momentum that we're seeing over there, Alcobev is in focus on the back of that recent IPL deal involving United Spirits. So overall, the consumption space has been in focus ever since September when the GST cuts were announced. We've seen the recent Q3 numbers where volumes and margins seem to be improving as well. So let's discuss this and much more. Let's do a full sectoral roundup with Mr. Mihir Shah, the Vice President and India Consumer Equity Research Analyst at Nomura, who's joining us on the show. Mihir, hi, good afternoon, and thanks for your time. So good to be catching up with you finally. First, let's talk about your recent view on the entire paint space. We understand that price hikes have been taken to combat the recent crude volatility that we're seeing. Help us understand what is the quantum of these price hikes, and does this pricing cycle look like a start of a structural uptrend, or is it temporary only to combat or offset the volatility that we're seeing from the Middle East?
Hi, Sneha. Thank you for having me. Pleasure to be here. So firstly, if you see the raw material basket for paints, it is up anywhere close to 35 to 40% in March over Feb. While companies have inventory for a few more months, and we will not see any impact on margins in fourth quarter. But if this continues, we will likely see pressure on 1Q, which has kind of triggered price increase from all paint companies, be it small or big ones. We have noted small price increases of 1 to 2% in March for certain solvent-based products, which are oil-based products. While come April, companies have announced a price hike of 6 to 8% across portfolio. We believe this companies are taking price hike in phases, and assuming if crude remains at these levels, the raw material prices that are seeing an inflation, to tide over that, they will need closer to probably about 10% price increase in our view.
Do you think, Mihir, paint companies will undertake another round of price hike if crude prices were to sustain above that $100 per barrel mark? I understand that the price increase, as you rightly mentioned, has been to the tune of 6 to 8%. How much have raw material prices increased by? And if you can contrast the impact on margins if these paint companies were to not undertake another round of price hike?
No, you're absolutely right. Like I highlighted, they are taking price increases in phases. The kind of quantum of price increase, raw material price increase that we have seen is closer to 35 to 40%. To tide over that, they will need closer to 10% price increase. They are calling out a 6 to 8% at this point of time. So we are expecting another round of price increase to come through. On margins, like I said, 4Q will not see an impact. 1Q margins can probably see 150, 200 basis points of impact. More importantly, what we believe is these price increases means that the dealers will start upstocking products, especially for the fast-moving goods that they have, and the companies can see some kind of advancement of volumes in the month of March and April.
Point taken. So here at the beginning, you did say that this kind of price hike that the companies have taken is not going to have any impact on demand and therefore on volumes. Could you elaborate on that point where there is no impact on volumes despite this price hike being undertaken?
Yeah, I mean, see, if you see the painting cycle is usually about 5 to 7 years, and mostly if you see the paint cost is nearly half of the painting cost, and does not, and we don't expect much of pressure on volumes because of this 10% price increase, because the effective price increase on the cost of painting will be just about 5% and can be absorbed. So unlike small ticket items of FMCG, paints work in a very different manner. The painting exercise is both time-wise and budget-wise, calculated by the consumers, and hence price increases in paints don't necessarily have a very sharp impact on volumes. Of course, a sharper price increase eventually will have, but these kind of price increase, like I said, the effective cost increase to the consumer will be just about half of the paint cost increase, and it can be absorbed.
Demand is largely inelastic, at least to some extent, and hence you're not expecting any impact on demand. But since we are talking about volumes, Mihir, also take us through what kind of volume growth are you penciling in for the entire sector for the fourth quarter and for the first half of FY27 in both the cases. In case these companies were to undertake another round of price hike, what will the volume growth be if there is any impact? And even in case they don't undertake a price hike?
We expect volume growth to be in the similar range what they have been doing in the recent past, of closer to high single to early double digit range. So we are expecting volume to hold up. There is a negative mix of about 4 to 5% that has been playing out since many years as they are penetrating into lower end of the products. And one leg of growth, that is the pricing led growth, was absent since 1.5 years. So what this price increase actually does is that it lifts the overall sales growth and operating leverage. We believe that with a volume growth of say closer to 7 to 10%, with a negative mix of 5 and plus a 10% kind of a price increase, overall revenue growth will come back from mid single digit level to higher than double digit levels or early teens as well. While they will have certain impact on margins in the near term as the pressure on raw materials are there, and it will be in nature, it will be have some impact in the near term. But we believe the margin impact will be transient as the benefit of the price increase will start kicking in the later quarters, and overall profitable growth will also start improving.
Okay, so Mihir, while that's on paints, and thanks for that roundup on paints, let's move away from paints and talk about some FMCG staple companies, especially on the back of this LPG impact that we've seen. Help us understand what percentage, or if you could quantify this kind of impact on listed staples giants on the back of LPG shortage, in terms of how much dependence these companies have on LPG, what are the alternatives, what could be the impact?
So we had actually done, an analysis depending on the back of the, figures that are disclosed by the paint companies in their sustainability report and their annual report. So our energy consumption analysis showed that most consumer companies have lower exposure to gas as a fuel, which is where the shortage is and which is where the government has highlighted that there will be a 20% cut versus what they were consuming earlier. And the ones that do have a higher exposure, which you are showing on your screen right now, they have multi-fuel facilities to mitigate factors. Thus far, we are not seeing any issue in production for any consumer products. And we also know that they have certain learnings from the past experiences like COVID, and they are carrying higher than normal fuel inventory and higher than normal finished good inventory as well. Uh, um, However, one cannot ignore that the overall fuel cost and more importantly, the packaging cost also is shooting up. And apart from the raw material inflation, there can be some pressure on margins because of this. And it will depend on the kind of price increase that the companies take.
Right, so that's as far as the impact of LPG shortage in the domestic and of course in the international market is concerned. But Mihir, also wanted your thoughts on expectations from the fourth quarter earnings now that we are at the fag end of this quarter. What kind of estimates are you penciling in from the entire basket, from the entire FMCG and consumption basket for the fourth quarter?
Yeah. So if you see, post the multiple steps that were taken by the government, which is the GST cut, tax cut, a lower interest rate, we had 2 consecutive years of above normal monsoon. We had lower inflation for a long period of time. So we had started to see volume growth improving in the consumer sector with each passing quarter after the sharp impact that we had seen post COVID. However, it is important to note that the growth rate in the volume growth in the consumer sector was still largely below the pre-COVID levels. So we were still impacted, and we were seeing an improvement with each passing quarter. For 4Q, with the benefits of the GST cut, I think we will see the full impact of the GST cut benefits kicking in 4Q, because 3Q there was certain upstocking, downstocking impact as well. And we expect a little bit of improvement on volumes on most companies in the fourth quarter, to see that coming through.
Okay, so sounding optimistic, and we're hoping to see that kind of volume growth and margin expansion, of course, for the listed staple giants. But Mihir, on that note, we'll wind down this conversation. Thanks so much for your time. It's been a lovely chat. Thanks so much.
Thank you so much. Pleasure.
Thanks so much. Okay, viewers, so that was Mihir Shah of Nomura. But time now to slip into a very short break. More news and updates to follow on the other side. So stay tuned.